Good morning, everybody. It's great to see you all up nice and early on a Wednesday. Thank you very much for attending our session today. So this is the third session in our series. All the recordings, we're sending links out to you, and they're also uploaded to our YouTube channel. And a lot of you don't know we have a YouTube channel, but we do. There's another great series on there called The 6 Steps to Successful Investing. It's an animated series, so that's worthwhile checking out as well. So just introducing myself for those who don't know me, I'm Steve Lowry, Director of Alman Partners True Wealth. And in this third series, we're talking today about the rise and falls of markets. One of the questions that we've been asked a number of times is, in our opinion, how long do you think this thing might last? And how long will it take markets to recover? So we're going to talk about that. We're going to look at history and talk about what's happened in the past and look at the duration of those markets. And then we'll just retouch on the art of rebalancing and taking advantage of when markets are down. Another question we've had is, should we be investing? And we certainly had quite a large uptake of new clients contacting us in the last week. We've been implementing a few new plans for clients who are wanting to take advantage of market volatility. So I hope everyone's all safe and well out there, and all your loved ones are all healthy. Don't forget that if you need anything at all, any assistance with Centrelink, any assistance with understanding JobKeeper, JobSeeker, small business incentives, etc. If you need any assistance, please pick up the phone and have a chat to us, and we'll help you any way we can. Okay, so we did in our series the first week, we spoke about the importance of staying seated. I think that's really come to bear. Those who have watched that series, we really talked about how hard it is to time markets. That if you miss the top 10 days in markets, your returns, over a decade went from 10% to 0. So it's incredibly important to stay seated during these times and not panic. I think we've all had a bit of that experience, in late January, early February, we were starting to really feel that this was something that we've never seen before, that markets could go into territory that we've never experienced. And of course, all of that fear and uncertainty priced into the markets very quickly. And we had markets by the end of February down 30%. By the end of March, we've seen a bit more optimism come in, a bit more understanding about where we're going, the time frames that it might take for us to get through this pandemic. And so markets are now minus 20%, pretty well across the board. So Australia, the US, and Europe. So the importance of staying seated, that's a great one to keep revisiting over your investment experience. Then last week we spoke about the importance of diversification. So that's really talking about how robust your portfolios are, how well diversified they are, and for our retiree clients, how we have a number of buckets that can provide income for many years, so that you're not in a situation where you might have to sell your equities, which is the last thing we want to do when markets are down. So just a disclaimer again, for those who are watching, this really is just an educational presentation. It's general information. Please don't take it as advice. So when we talk about should you be investing now, you really should make sure you're talking to your financial advisor and making sure they've looked at all of your situation and your longer term goals and your risk mitigation strategies, particularly at the moment, before you make any investment decisions. That's very important. The graphs we're going to look at in a moment are the S&P 500 index. So that is the top 500 shares in America. I really wanted to focus on the US because it is our largest capitalist economy. And so looking at what's happened over the last 80 or so years in those markets, I think is a good lesson for us all. So you've probably heard these statements over time with the share market. We've got a bull market or we've got a bear market. At the moment, we're in a bear market. What does that mean? Well, quite simply, it just means that the share market has fallen more than 20%. And that's what determines a bear market. And so we're certainly in that period at the moment, although popping our head back out pretty quickly. We don't know where that's going to go in the future, though. So we've had a very strong bull market for a decade, where markets have done very, very well. And so today we're going to concentrate on bear markets over history and just see how far they fell and how long they took to recover. And the other thing I wanted to bring up is, a recession is very different than a bear market. So the term of a recession is generally crystallized when you have 2 quarters of economic decrease. So 2 quarters in a row, that generally is a sign that we're in a recession. But I will be talking at the end of this presentation about our views and what we're hearing, and some of the respected economists that we do listen to, what they're saying at the moment. So we'll wrap up with that at the end. All right. So before we get into this particular slide, if we go back one more, I didn't put it in this presentation, but we had the Great Depression in the late 20s. The S&P 500 fell 86% in the Great Depression, and took a number of years, about 3-4 years to recover. So it was an extraordinary time, and at the moment you're hearing commentators saying, the economy's in a position, and unemployment rate's going to be in a position that we haven't seen since the Great Depression. A couple of things happened in the Great Depression that caused the market to fall so far and take so long to recover, and that was the fact that governments just didn't understand the whole idea of stimulus, getting in early and getting the economy stimulated. Nothing like what we've seen now, and in the GFC as well. So governments have learned from that. You've got to get in quick. You've got to get confidence back in. You have to get liquidity to businesses. You have to get income to people. And so we wouldn't expect that we would see a fall that big, but who knows? So this slide here, this is the beginning of World War II, and the markets fell 41% to its bottom. So that's its bear market, and then it took 24 months to recover, and then go on its journey again. 1946 to 48 was another quite a large fall in the US market, and this was on the back of inflation. So inflation was getting quite high. We've come on the back of a war. People started hoarding their cash, not spending, worrying what the future was. So really it was an inventory recession. In other words, there just wasn't a lot of demand, and so markets fell 27% in that period, and took 3 years to get back to their previous peak. 56, 57, 22% fall on the market over a year period, and that was all about the Suez Canal crisis. You can read your history books about that, but that was just an amazing amount of uncertainty in the world. It was quite a large uncertainty about supply getting through, using the canal, etc. So markets fell, but they rebounded quite quickly. So you can see there pretty well the next year they were much higher than they were before. 61, 62, the Kennedy slide, the Bay of Pigs, the ill-fated invasion attempt into Cuba. Markets fell 28% on the back of that. That was an incredibly nervous time for those who are older than I am. I was born in 1962, but markets fell 28%. This was the point where the world was on the brink of nuclear war between the Americans and Russia. Anything could have happened, threats all over the place that the button would be pushed. Incredible uncertainty, and you can see there markets fell with that uncertainty. 12 months later, confidence came back into the market, and off we went again. 1966, Federal Reserve had a credit crunch, so there was a tightening of money supply, and markets fell accordingly. Another 22% return from top to bottom, and then quite a quick recovery. And their markets are a bit volatile. It's important to see after markets recover the volatility that continues on. That's a normal part of investing in markets. And you can imagine on the back of some of this bad news, when you see a fall of, maybe another 15% there in 1968, that can get quite unnerving and bring up, in our emotions, the feelings, what we went through previously. And just bear that in mind when we're going forward over the next few years for us, that we'll have times where there's a bit of uncertainty and news isn't great. And maybe one of our favourite companies goes broke and markets react. Those things are most likely going to happen. And then we go into the Vietnam War, 36% fall in the late 60s, early 70s. Pretty well, markets recovered quickly, found their ground over a 6-month period to 2 years, and then continued to grow. So I don't know if you're seeing a little pattern. There's 3-4 year duration, 6 months duration, 2 year durations. Pretty hard to pick what we're going to go through. The lesson to take out of this is that markets do recover over time. This was a doozy. So in the 70s, again, if you remember this period, there was oil embargoes. We had incredibly high inflation in the 70s, and markets fell from top to bottom in a very short period of time, 48%, much larger than what we've seen right now. And 21 months to climb back up, 2 years to get back to where it was. Again, very uncertain times, and very quick fall there. You can see that. So there would have been an amazing amount of uncertainty, and if people didn't stay seated and they didn't have their diversification right, they probably should have sold out, and obviously a lot of people would have lost some money. In the 70s, interest rates were just rising quickly on the back of that high inflation, trying to bring that down so they get prices down. Another 19% fall from top to bottom. Then moved pretty quickly into another oil crisis and an inflation bubble again. And so 27% fall in markets over a 1.5 year period. Again, look at the volatility. Down in the first period in 81, back up, big fall, back up, another really large fall. And then look how quickly it recovered from July to October, which again just reinforces you've just got to stay seated and wait for these things to happen. 87, Black Monday crash. We had a fall in the Australian market of 38% in 1 day. Incredible. And I think that was Scott had been in business for 2 years, and that was his baptism by fire as an investment advisor. Bam, down she went. A lot of that was triggered by speculation on markets and computerized trading that basically got it wrong. But markets went in a tumble, and it took many years to get back to its previous high in America. In Australia, it was nearly 5 years. We then went into Iraq war and the US recession, 20% down again, quick recovery. Now this one here, a lot of people don't remember this, incredibly, but this is another one of the largest falls in markets in the US, the dot-com bubble. So we had, everyone was going, technology is going to be the new savior of markets. It's a place to put all your money. We had the birth of the NASDAQ index, and people starting up tech funds all over the place, and the bubble burst. A lot of these companies had high incomes, high exposure, but no profit. And so, the tide went out, and they were seen to be bear. And so markets fell 43% over a very short period of time. So from top to bottom, 3+ years to get back to where they were. That's what patience is all about. We then had the global financial crisis, so 57% fall in the US market. Again, most of you who are in this presentation are longer term clients. We all went through that together. Very challenging times. What we're going through now is very different than what we went through with the global financial crisis. We were at a point really where the global financial system could have fallen over. It was incredibly challenging and a very fine line. And I'm going to talk about my conversation with Professor Ed Lazar at the end of the presentation, who I was fortunate to have dinner with. He was the chairman of the Economic Advisory Council for George Bush right in the middle of the global financial crisis. So sitting next to him having dinner in Sydney for a couple of hours was fascinating, as he explained what they went through that period. So I'll talk a little bit about that and what his views are on where we're heading and what the differences are between that crisis and what we're experiencing now. So quite fascinating for a finance nerd like myself. We had tsunami and US debt downgrade, 22% fall. Again, markets recovering relatively quickly. Chinese economic concerns last year, markets down another 20%, a rebound relatively quickly. But when you look at that whole journey, that's the S&P 500 over that whole period. So it doesn't look as scary, does it? It is really, it's a long period of time, of course. I don't have the exact return figures on that, but you can see markets, went from 10 up to 2,000 or thereabouts. So, and then we're looking at the fall then that we're experiencing now, which is 20%. Putting that into perspective of what some of those other market volatility experiences were, not quite as bad, but it definitely is a different beast. And so we'll talk about that now. So no questions, so I'll continue on. I want to talk about Professor Ed Lazar and that conversation that we had together in Sydney. So first of all, being the economic advisor and the chairman of that board to George Bush through the GFC, he had a complete insight into what was happening in the White House. He told me quite frankly over a couple of wines that when George Bush looked at all the council in his room and said, "What's going to happen?" and their answer was, "We don't know, sir," his face went white. This was just after Lehman Brothers collapsed. So incredible uncertainty. What do we learn out of that, though? The response from the world to make sure that the capitalist economy didn't collapse was strong, fast, and focused. And that really got us through what was an incredibly challenging period. In 1998, there was a hedge fund who was speculating billions of dollars on currency. Long-term capital was their name, and they took a multi-billion-dollar bid on the Russian currency, which went the wrong way, and that one thing nearly destabilized our whole economy. Not many people heard about it because they got a very quick bailout. Everything got fixed. I don't know how they do that, but it was all rosy not too far afterwards. So the economy isn't immune to big hits, but it's as Ed Lazar said, it's too big to fail. And so what we're seeing now is a collective response worldwide to make sure that we get through what could be 12 months of us in isolation, and businesses really struggling. Some businesses doing extremely well, and other businesses having to mothball pretty well for the next 12 months. So Professor Ed Lazar, he's a board member on the Global Investment Committee for Dimensional Fund Advisors. I watched a 28-minute presentation webinar with Professor Lazar. He's a professor at Stanford University on what he views what we're going through, and his guess, and it is only a guess, on where we might end up. So his view is really that at the moment we've had a fantastic response from governments. It's been strong. It's covered the whole of society, big business, small business, individuals. We've got the job seeker, job keeper. We've got the UK paying, I think it's 75% of salaries for the whole country for the next 3 months. Extraordinary times to keep liquidity. The one thing that Ed said was, this is not a stimulus. And that's a really important definition. A stimulus is where you get a lot of money and you go and spend it. This is all about liquidity. Stimulus is exactly the opposite of what we want, and what the governments want. They don't want us all running out to shops, spending and spending time together. What they want to do is keep liquidity going, so people aren't defaulting on their loans. Businesses can keep people employed for as long as possible, can keep them off unemployment. That's really important. His other distinction was that it's much more expensive to start a business from scratch than to reignite a business that's been in hibernation for a period of time. And so the liquidity measures are to try to get our most important businesses through this time until we come out the other end and can start trading again. His best estimates are we're probably looking at 6 quarters of negative economic performance, and after six quarters we should start seeing some strong signs of the economy growing again. Again, that's a guesstimate. If you're listening to news and you're reading the news.com and all those places, everyone's got an opinion, right? But I think Professor Lazier and the people that he spends time with, particularly on the Dimensional Investment Board, some of those who we've mentioned before have Nobel Prizes. They've probably got a really good finger on the pulse from an academic point of view. So that's really his thoughts on where we might be going. I think for us, we're doing everything we can. We're following the principles we've spoken about in the last 3 weeks. Whether it's 1 year, 2 years, or 3 years, markets will recover and continue to grow. And our job is to make sure that we don't make wealth-destroying decisions right in the middle of that. So moving on to the last bit, I just really wanted to touch on rebalancing. So we've gone a little bit over today, but we are looking at portfolios, and we spoke quickly about this last week, but we have set certain tolerances for your Australian equities, your global equities, and your cash and fixed interest. And so when those tolerances go past about 5%, we're generally looking and saying, well, if it's 5% growth, should we be selling and take some of that off the table? And if it's 5% down, should we be using some of the cash that's now increased as a percentage and start buying markets when they're down? We're looking at that. Firstly, we would prefer to rebalance with cash. So for our retirees, that's a bit easier. We can use the buckets without putting in jeopardy their income. And for our growth or accumulators, we generally prefer to rebalance with new capital. So superannuation is easy. We've got money coming in all the time. We can rebalance. And the third thing that's making it difficult at the moment is markets are jumping so quickly. So if we rebalance too quickly and markets jump, we're trading all over the place, which has its own issues. So just for your thoughts, we are looking at your portfolios. We'll contact you when we think we need to do any rebalancing. Other than that, we'll pick things up at your reviews and look at them at that point in time. So that's really it today. Thank you so much for joining us for the 3 series of the webinar. We really hope that it's been beneficial for you. The feedback's been great. We'll go away and think about whether we'll do a few more for you in 4 weeks' time or so. Continue to look out for our blogs. We'll continue to get that information out. Lastly, if you're a information person and you digest a lot of data, we have mountains of information of what's happening, how we view things, economic viewpoints, etc. So if you'd like to tap into any of that, please just drop us a line and we'll send you some papers that you might want to read. For others, if this information's been enough to give you comfort and keep you focused on what's most important, and that's how I'd like to wrap up today. Remember, we're important, our families are important, our longer term goals and aspirations haven't changed. Your wealth tracking goals, we'll be looking at those at your reviews, but we're certainly moving towards those. So keep positive spirits, make sure you're being charitable and giving to others, and we'll look forward to talking to you in the not too distant future. Thanks for attending.